The Tax Resolution Institute presents the final tangible property repair regulations and fixed asset review, opportunities for 2016 and beyond, presented by John Hanning of KBKG.
Hello and welcome. A little bit about KBKG first. I want to talk about the fact that we were established in 1999 with offices across the United States, including California, New York, Chicago, Dallas, Atlanta, and Columbus, Ohio. We provide tax solutions for CPAs and businesses, some of which are R&D, cost segregation, energy tax incentives, repair versus capitalization studies, IC incentives as well. We perform thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Now, our team is a diverse mix of specialists, attorneys, energy consultants, engineers from various disciplines. This combination of talent certainly allows us to focus on our areas of service to maximize the results for our clients. A preferred provider for many, many CPAs across the country. Again, a little bit about myself. I am a director here at KBKG. I work in the fixed assets cost segregation practice. I complete most of the accounting method changes for our service line. I got a degree in economics with an MBA. You can see Ohio schools are a theme there. And I hold my lead green associate credential, and I'm also a certified member of ASCSP, which is American Society of Cost Segregation Professionals. Now, the repair regs are old. They dropped in 2013. So to freshen up the course today, I've included a couple of items from the PATH Act. The PATH Act did come out in the early part of 2016, and so it's certainly to your advantage to know that bonus depreciation and 179 expensing has been extended, retroactively reinstated, and also been made permanent. So I'll go through a couple of those items here over the next slide. PATH Act, protecting Americans against tax hikes. Again, retroactively reinstates 50% bonus depreciation for 2015, but then also extends it through 2019. 2015, 16, and 17 will have 50% bonus, with a phase-down period in 2018 at 40% and 30% at 2019. Now, Section 179 increased expensing amounts for small businesses have now been made permanent at the $500,000 level, and that's inflation indexed. However, it should be noted there's a dollar for dollar phase out at the $2 million number. So at $2.5 million, you're completely eliminated and phased out of that. Additional opportunities under the PATH Act. Qualified improvement property is new. Everybody is familiar with qualified leasehold improvement property. However, let me run through some of the criteria that's been set forth within the qualified improvement property. Again, which is new for 2016. So we believe that it's going to set forth criteria making it available for certainly a broader set of taxpayers. And let me explain why I say that. Is that qualified leasehold improvement property had a couple of clauses which, if we're not satisfied, disallowed you from taking that opportunity. So in the qualified leasehold improvement property, there was a 3-year rule and a related party lease clause. So that has been eliminated in qualified improvement property. Now, qualified leasehold improvement property was recovered over 15 years. Qualified improvement property is being recovered over 39 years. However, it is bonus eligible, and again, there's no 3-year rule and no lease requirement. Again, this is for newly constructed assets in the interior portion of the building. Additional opportunities under the PATH Act. R&D was made permanent. This is very exciting news. All of my colleagues that are in the R&D space, waited every year to find out whether they were going to have a job or not. That's not the case anymore. R&D has been made permanent, which is very, very exciting news. Additionally, 179D energy efficient deductions was extended for commercial buildings through 2016. Now, 179D allows for $1.80 per square foot of a deduction for designers of government-owned buildings or building owners that are going ahead and constructing a building that has a large footprint and, of course, is green. 45L is an energy efficient tax deduct credit, not a deduction, for multifamily and residential developers. So again, this has been brought back through 2016, and 45L is for low-rise apartment developers and or single-family home builders, which are eligible for a $2,000 credit per unit or per dwelling. And there's a definition of what a dwelling is, so it should be noted and understood. Retail restaurant safe harbor. What practically happened in 2013 and prior is retailers got together and through the National Federation of Retailers and said, look, these regs are very, very difficult for us to implement. We are brick and mortar stores throughout many, many states, and we need some additional guidance. And so this was what spawned of that. Retailers then got together with restaurant owners, and this was created. The one thing I want to point out on this slide, and I think that seems simple, but you can immediately deduct 75% of qualified amounts spent to refresh certain property. And then, of course, you have to capitalize the remaining 25%. From a practical standpoint, it seems pretty easy, but it's not just taking 75, if I built something for $1 million or refreshed a property for $1 million, I don't just apply 75% and walk away. The term qualified is highlighted there, is that many, many items need to be deducted from the calculation prior to then applying the 75%. So again, please make sure that you understand fully the rules. We've got some very large retail clients that are trying to get their arms around this, and the calculation is proved to be quite difficult. So know that this is out there. A couple of additional items on this are a qualified taxpayer is one with applicable financial statements. We're not talking about the mom and pop grocery store that they have maybe a handful of locations. What we're talking about are the large national chains throughout the country. That also goes to restaurants. So if you've got one restaurant in one strip mall, this is probably not going to be an opportunity for you. But if you own multiple McDonald's across the United States, this is something you want to take a look at. Again, there's certain locations that have been excluded for the retailers: automotive dealerships, motor vehicle dealers, non-store retailers. That's just quite simply online retailers. Non-brick and mortar, certainly they're not doing extensive remodels. In addition to that, at the bottom slide, excluded were hotels, motels, casinos, country clubs. These are locations that might have restaurants, and they have been specifically excluded from the retail restaurant industry safe harbor. I did a white paper, and it is listed on the bottom of the slide there. It's about 8 pages, and again, it's just kind of a question and answer white paper that explains a little bit more about the calculation we talked about, but of course, the rules set forth within this safe harbor. You might want to take a look at it if, again, you have clients that might be in this position. IRS just recently released the Audit Techniques Guide for capitalization of tangible property. That was released in September of 2016. Now, getting our arms around what's within, what I want to mention here is just basically it was about what we thought it was going to be. So everything, the copy that I received from the service on the tangible property regs back in 2011 was 222 pages. Or, I'm sorry, 2013 was 222 pages. Now, it was a little over 200 pages for the audit techniques guide. So the explanation of how to actually apply the rules within the tangible property regs was quite extensive. What we can take away from this recent release is that, okay, it's pretty consistent for what we thought it would be, but they've released this because we believe they're going to start auditing those reports that were done to seek compliance on 263A, and so they're training their internal staff to go out into the market and seek opportunities for whether or not companies had done this correctly. The tangible property regulations is why we're all here, and so this is the meat and bones of what we're going to talk about today. Repair versus capitalization. Now, right out of the gate, I'll tell you this is, the determination is highly factual. The guidance certainly revolves around what constitutes the unit of property. So we'll talk quite extensively about what is unit of property and how it's defined. So just as a quick example, in the context of the unit of property, $30,000 of cost for 5 new plumbing fixtures, where again the unit of property is the plumbing system in a very small 5,000 square foot building. And I'll tell you, this is likely a capital improvement. I'll flip it on its head and say $30,000 for the same new plumbing fixtures, where the unit of property again is the plumbing system. However, now we're in a very large 50,000 square foot building. My answer then changes to say, maybe this is most likely a repair. So the smaller the unit of property, the more likely the rules set forth within the tangible property regs are going to force you to capitalize that expenditure. It reverses itself in saying that if you have a very, very large unit of property, what you're actually going to end up with is potentially a repair expense. Say, for example, if I was on a plant floor with $2.5 billion of capital. And that capital, as it was explained to me, is just doing one thing. Well, it's all functionally interdependent. And placing one item in service is certainly required to place the other item in service. And so what the individual in that scenario is doing is making the unit of property as large as possible, so then if I just replace $1 million valve among $2.5 billion of assets, I'm very likely not going to get to a capital improvement. Well, an assessment truly should be done on, what is the unit of property for your specific scenario. It's been defined for us for buildings, but if you've got a manufacturing space that there is room for interpretation, you want to make sure that you've taken some time to do your due diligence on what is the unit of property, so then certainly you can apply these rules. So what is an improvement? An improvement is defined as an amount paid after the property was originally placed into service, which is a betterment to the unit of property, adapts the unit of property to a new or different use, or restores the unit of property. This is commonly referred to as the bar test. Now, if you fail the bar test, and you'll hear me talk about that, then you're going to be forced to capitalize that asset. If you pass the bar test, very likely you're going to get to a current year expense under the repair rules. So what is the unit of property? A functional interdependence test. So all the components are functionally interdependent. They will comprise one single unit of property. Components are functionally interdependent if, of course, placing in service one of the components is dependent on placing into service the other components. There are some special rules, and we'll talk briefly about some of them, but plant property, network assets. Network assets are, for example, gas distribution or electrical distribution. Is it, each section of pipe, it's its own unit of property. Is it pump station to pump station, or is, I needed all the pipe. I couldn't have a hole in the pipe, so they were, functionally interdependent. There is some confusion around that. That's why, the service has certainly released guidance around that, and you'll find that available to you. Now, we will spend quite a bit of time today talking about buildings and leasehold improvements. I think that's going to impact most of our audience today, but certainly it will impact, my guess is about 85% of the scenarios that are out there. So buildings, what is the unit of property for a building? The building and its structural components are one single unit of property. The building structure consists of building and its structural components other than the structural components designated as building systems. I'll tell you that listed there are 8 building systems, but of course you see 9 numbers. So it's 8 building systems plus everything else. So the rest of the building, the walls, roof, floors, ceilings, windows, so on and so forth. This is critical. This is new. The service has never defined for us what the unit of property was prior to the final regs coming out. So it's good to know that we have some guidance around what constitutes the unit of property as it relates to building systems. Leased buildings. So the lessor owns the entire unit of property. The unit of property is the building itself. So for multi-tenant buildings, the unit of property was always the entire building. And of course, they must evaluate their repair expense based on the building system level. Now the lessee, the unit of property is the portion of the building that is leased. This is the cubic space that Abercrombie & Fitch leases, where the lessor, that's going to be your Westfield Mall. They're the owner of the entire structure itself. So for the lessee, for multi-tenant buildings, the unit of property is, again, just their space, just the cubic space in which they rent, combined all future improvements to the leased portion into a single unit of property being leased. So again, you still must evaluate at the building system level. A couple of examples here. The lessee in a large building, so let's say Abercrombie & Fitch in a mall, remodels the bathroom in their space. The expenditure is likely a capital improvement because the work was done on a major portion of the plumbing system located within their space. However, if the lessor performed the same work, it might be a repair because it only affected a small portion of the building's entire plumbing system. So again, you must look at it from a lessor-lessee lens and make sure that you understand what the unit of property is. Additional rules for unit of property. I commonly refer to this slide as my personal property page. Now, the depreciation consistency rule says if a component is treated as a separate unit of property, if it's being depreciated as a separate class of property. And I'll give you a couple of examples at the bottom there. But say 5, 7, 15-year maker's property are separated from the unit of property from the building. So again, the example being, cost segregation study was done on a hotel which segregates electrical systems into categories with 5, 15, and 39-year lives. 5, of course, being the personal property. 15 is maybe the lighting in the parking lot, and of course the lawn life property, the real property of 39 years, which is potentially general building lighting. 5-year property includes hotel decorative chandeliers and wall sconces. So future expenditures to replace the decorative lighting are compared only to the 5-year lighting cost, not the entire lighting system within the building. It's critical to understand that if you do break out within a cost segregation study these accelerated components that in the future you understand what the unit of property is when applying the rules. So certainly a cost segregation study should summarize the building's unit of property. In the past, that was not happening. Of course, when the final regs dropped, we did understand that that would be certainly important for future dispositions. But however you use a cost segregation, it certainly should summarize the building's unit of property. What is a betterment? This corrects a material, condition, or defect. Is a material addition, enlargement, expansion, or extension of the building. Is a material increase in capacity, productivity, efficiency, strength, quality, or output. Now, every time you ask facilities manager, hey, why did you do that? We were improving it. So anytime there's the cost going into a building, it's the common response is we improved it. Now, how much did you improve it? The word material has not been defined by the service, so there's an area for controversy. But even though you believe you've improved the building, or when you replace the HVAC system with a new one, of course it's going to be more energy efficient. But if you try to replace like for like, if you try to replace a comparable unit, then you're going to not kick yourself out of the opportunity to take it as a current year expense. It also should be noted that enhancements due to technological advances are not necessarily a betterment. HVAC equipment is always going to be more efficient. However, you should ask yourself, is it comparable? Or in my term, is it like for like? We're going to go through several betterment examples here. Asbestos removal. This is taken right from the regs. There are, I think, many examples within the final tangible property regs that allow clients to get their arms around different scenarios that they may have. So I encourage each one of you to look through those to see if you can find a scenario that's similar to yours. Typically we in the industry use the HVAC example or the roofing example, but again, go through each one of the examples, see if you can find one that matches your current situation. Another example, at the time of purchasing an assisted living facility, a taxpayer knows it needs work, so right after the purchase, for a period of about 2 years, while operating the facility, so it's been placed into service, the taxpayer pays for extensive repairs to bring the facility to a higher quality condition. Now, this is an amelioration of an existing condition, so it ameliorates a previous material condition, which of course is a betterment. Reconfiguring office space to add more cubicles, and they spent $30,000 to add 50 more electrical outlets and video data jacks, where I'll add to that, where none existed before. This is likely a betterment. It's kind of a trick question, because if you're adding something that was completely new, of course it's a betterment, and of course it should be capitalized. Now, if, for example, you took the old analog phone system and replaced it with a digital phone system, well, in that case, I will tell you that it's probably a repair. But you tried to replace like for like, just because of technological advances doesn't preclude you from taking it as a current year expense. Not a betterment. Replacing wood shingles that are no longer available with comparable asphalt shingles that are stronger than wood shingles. Now, stronger than wood shingles, do I automatically say that that's a material increase in strength? Well, not necessarily. Again, we're trying to replace like for like, or we're trying to replace the asphalt shingles with a comparable, or the wood shingles with a comparable asphalt shingle. Just because of technological advances doesn't preclude you from taking it as a current year expense. So therefore, it's not a betterment. It passes the bar test, and therefore I can take it as a current year expense. The last example here listed is a betterment, replacing the same shingles with a lightweight composite shingle that are maintenance-free, 50-year warranty, and a Class A fire rating. makes your coffee for you in the morning. Of course, now we've transitioned to trying to replace like for like to replacing something that is far in advance of what was there existing or what was in place before. So that certainly is a betterment. Adaptation. I'm not going to spend long on adaptation. That is my only slide for adaptation. So I do want to point out, though, if you adapt something to a new or different use, you have to capitalize it. It's that simple. Now, I've got a lot of clients that say, well, what if it's kind of, it's not black and white, it was an office building and we're kind of using an office building, but really its main function is a warehouse. Look, I think ultimately you just have to be honest with yourself. You have to guide your clients, and so they truly understand, there's potentially some risk associated with that, but the answer out of the regs is pretty cut and dry. If you adapt something for a new or different use, you have to capitalize those costs. So, for example, A converts its manufacturing building into a showroom for its business. They replaced some lights, painted some walls. They'll downplay it. The client will downplay it. It's just some other components. It was, just so it had a better layout for the showroom and offices. The taxpayer has to capitalize those costs. So, again, it should be commented on the bottom. If they only did those items for their manufacturing operation, but again, it remains a manufacturing space afterwards, of course, absolutely. You may pass and satisfy the bar test, allowing you to take a current year deduction on those assets. But again, if you choose the space going from manufacturing space to an office or a showroom, you're going to end up having to capitalize that for sure. We see this a lot in potentially, for example, a manufacturing of mattresses. And they were always selling them out the back door. But now they said, well, why don't we just sell them out the front door? So they took about half their space and made it into a showroom. Cost associated with that, and in that scenario, is certainly going to have to be capitalized. What is a restoration? It is a replacement of a major component or substantial structural part. It returns the unit of property to an ordinary operating condition if in a state of disrepair and or no longer functional. It rebuilds the unit of property to a like-new condition after the end of its asset life. And of course, the class life is determined or defined as the ADS life. That's different for buildings. We'll talk about that in a couple of slides from now. For buildings, it's been defined as 10 years, but everything else, the class life is the ADS life. Replaces the component deducted as a loss or adjusted basis taken into account for that gain or loss. So what I really want to talk about in this slide is that if you're rebuilding something to a like-new condition after its ADS class life, you're going to have to capitalize it. It's kind of a no-brainer. Don't try to take something that, like potentially, it was amelioration of an existing condition. It's been completely exhausted, and now we're going to put some money into it to make it new. You're going to end up at a capital improvement. Defining what is a major component. Now, these are parts that perform a discrete and critical function for the building system or the unit of property. Lighting, air conditioning, walls, water heater, so on and so forth. The substantial structural part is the physical portion of the building or unit of property that is significant. So if I replaced more than 50% of that lighting, that potentially constitute a capital expense. Again, you have to consider all the facts and circumstances, both quantitative and qualitative. From a practical standpoint, what always happens is that the controller gets the cost and said, oh, that's a $30,000 cost. Well, clearly, that $30,000 cost needs to be capitalized. Now, that individual didn't go through any of the assessments that we've talked about so far to make the determination of whether it should be capitalized or whether it could be expensed. They just simply looked at the cost. So it's not just the cost, but the size, type, function, etc. Another caveat here at the bottom is that the replacement of an incidental component of a unit of property will not constitute a major component, even though it affects the function of the unit of property. The best example here is an HVAC thermostat. Everybody's going to the new Nest system, right? And so you can control the heating and human thermal comfort of the structure from your iPhone. Well, yeah, that's a major part. That's the entire brain of the system itself. But in reality, it's pretty minimal. The cost is pretty minimal as it relates to the overall HVAC system. Therefore, just that small replacement or just that like-for-like replacement or comparable swap for a new control doesn't constitute or force you to capitalize that. Restoration examples. So X owns a retail store and discovers there's a leak in the roof. X replaces 60% of the roof decking, roof insulation, and roof membrane. I'm going to call this a restoration. It is an improvement. It fails the bar test, and I'm going to be forced to capitalize that. Now, the operative word here being roof decking. We've impacted now the structural components of the building. This isn't a rubber membrane for rubber membrane replacement, a comparable like-for-like replacement of just the rubber membrane. This is potentially a major overhaul of the roof decking and or could have impacted the trusses. This has now impacted the structural components, and any time we're impacting the structural components, we're going to be forced to capitalize that. Now I'll take that example and flip it on its head. Y owns a factory building with roof comprised of structural elements, insulation, waterproof membrane. However, Y replaces only the membrane with a comparable, or in my term, like for like, new membrane. So it's not a betterment, and even if potentially you had the old black rubber membrane and you went to a reflective acrylic white membrane, that's just an advancement in technology of the day. Again, its core function is to repel the water. It's like for like, it's still comparable, and it's still not a betterment. So the roof membrane is a minor portion of the roofing system, even though, again, it affects the function of the building. It's not a restoration, it's not a betterment, and because it passes the bar test, I'm going to call it a repair expense. Roofing examples are pretty clear, cut and dry within the examples set forth within the regs. All day long, like-for-like rubber membrane replacement is going to be an expense. Doesn't matter how much you replaced, it really just matters, did you replace it with a comparable or like-for-like unit? A couple of examples here, just so you can see visually. Roof repairs, we've talked about that on the previous slide. Parking lot maintenance. Now, slurry coat seal. That is when, and you potentially have seen it as you're driving by a parking lot, is tar is being squeegeed onto the top layer to fill in the cracks and to prolong the life of the asphalt drive or parking lot. If you've ever played the game telephone when you were a child, you know, the game was such that one person would start and go around the room, and secretively the information that the first person started would be passed to the others. Well, inevitably, if the first person said, you know, I like ice cream, by the time it got around, it would say, we went to a baseball game. So the information changed along the way. I point that out just because if a facilities manager, maybe a facilities manager of a very, very large Westfield Mall, $50,000 to do a slurry coat seal. And that information was transferred to the controller or, you know, the director of tax. And What did you do? Oh, well, we did a slurry coat seal on the binder course to prolong the life of the parking lot. Okay, what the controller may have heard is new parking lot, and so that's what's listed in the depreciation schedule. Well, of course, a new parking lot, one where it didn't exist previously, is going to be a capital expense. But a slurry coat seal to prolong the parking lot can be determined as a current year expense. So it's very important, and I bring this up quite often with my client base, that you need to take a look at what the specific scope was for each of those projects. I know that everybody's limited in the amount of characters that they can put within the description field, FAS or SAP or whatever software you're using, but it is critical that as much information of what the scope was is transferred into those fields. So we truly know, or for like a specialist like me coming in a couple of years later, we truly know and can identify that as a repair, despite it being capitalized. Restoration standards must be applied to all major components of the building or unit of property. You first must identify the major component of the building system, then to see if a significant portion was replaced. So several HVAC examples here over the next couple of slides. An office building has an HVAC system. It's comprised of 3 furnaces, 3 AC units, and some ductwork throughout the building. One furnace breaks down and was replaced with a new furnace. So the 3 furnaces together perform a discrete and critical function for the HVAC system. 3 furnaces are a major component. However, just replacing one, or 33%, is not a significant portion of the major component. It is not a restoration. It passes the bar test and can be should be expensed. I hear all the time feedback is, great, John, can you just explain to me what that percentage is? Is it 30 or 20% or 40%? And again, there are no bright line tests that were provided within the tangible property regs. But if you read all of the examples set forth, you may get comfortable with between 30 and 40%. Again, I hesitate even saying that because that is not a bright line test, but is a good general rule of thumb that you can use when taking a look at your own scenarios to see if you've impacted the major component or not. Again, another example as promised, an office building has one HVAC system comprised of one chiller, one boiler, and a cooling tower. The chiller is replaced with a comparable unit, like for like, right? The chiller performs a discrete and critical function of cooling the water to generate the AC. So because the chiller performs a discrete and critical function of the HVAC system, you're forced to capitalize that. Now, same scenario, but again flipping it on its head. Let's assume now, the same example above, there are 4 chillers and we only replaced one. It's 25%, and therefore you're likely to get to a repair expense position. HVAC has, there are 10 rooftop units. We call them RTUs, but 10 rooftop units, condensing units on the roof that are supplying cooling to different areas of the building. So in the example, the controls allow for distribution of heat and AC to various spaces. The building experienced climate control problems in various offices. So the owner replaced 3. That's 3 of the 10 roof-mounted units. 10 of the units are a major component of the HVAC system, so the replacement of just 3 is not a significant portion of the major component, is not a substantial structural part, not a restoration. We pass the bar test. It's not a betterment. It certainly can be taken as a repair expense in the current year. Again, clients calling, hey, I've got a couple of questions. They replaced an HVAC system. Is that a current year expense? We don't have any information. Look at all the information that you need in an effort to make that determination. And that's the reason I have this next slide, is that frantically I get a call from a CPA who just got called from their client and said, hey, I heard about expensing cost as it relates to replacing a rooftop unit. They said they replaced a rooftop unit, and I need to know if that is an expense. And hurry up, because I'm going to call them right back. Well, oftentimes I quickly just ask, where's the building located? And if it's a good client, they pretty quickly know. I might even just get on Google Earth and take an aerial image of what that building looks like, understanding, yes, they own the entire structure. So I'm asking questions to the CPA to source a little bit of information, doing a due diligence on my own behind the scenes. But in the left photo, you can see there are 5 rooftop units. If I ask the CPA, yeah, they just replaced one. I have the invoice here. This is what it says. The replaced one at, let's say, $15,000. Well, replacing one of the condensing units, and I find that they have 5 by using Google Street View or Google Earth aerial images, I can support that as a current year expense. So there's some tricks out there. Your client may put you in a difficult position where I need the answer right away. Maybe that's a resource you guys can use in an effort to help support your answer, whether it might be, no, you're forced to capitalize it because I understand you only have 1 unit, or, hey, yeah, you can take it as a current year expense because clearly it's only 1 unit of, in this example, 5. Retirements and dispositions. So the final regs were issued in August of 2014, so about a year after, or nearly a year after the final regulations dropped. So the new rules say that you now can take a loss deduction when you remove anything from your building. Let's go through a couple of examples. So if you pay $50,000 for all new lighting in your building, and you need to capitalize that amount, it's building general lighting over 39 years, it's real property. You can now calculate the value of the old lights and take an immediate deduction on any of the remaining basis that might be there. So partial disposition election is needed now to be made on a timely tax return, including extensions. Previously, in 2014, the service under 196 accounting method change allowed for late partial dispositions. That has sunsetted now. That opportunity no longer exists, but partial dispositions, if made timely, that opportunity is certainly still available to you. So again, if you're forced to capitalize the expenditure of the new item, you can take a loss deduction for what has been thrown into the landfill. The retirement of a structural component. A good example here. So a taxpayer acquires a $5 million building in 2009. And in 2015, they spent $1 million to remodel a portion of the second floor. Ceilings, walls, lighting, plumbing, ducting, some general rework. A retirement study determines the original basis of the demolished components was $470,000 in this example. Again, that's from the original $5 million that was placed into service in 2009. They can now recognize a loss of $404,000, which is the original cost minus or less any depreciation already taken. That's quite significant. And you may have clients out there that could capitalize on the disposition rules. Now again, I want to be clear that you can't double dip. You can't take something as a current year expense and then also do a disposition. It is only when you are forced to capitalize the cost of the new asset that this opportunity is available to you. Why are retirements or dispositions important? So, and the reason they are is due to recapture, and I'll do an explanation here. So if you incorrectly depreciate 1245 personal property or 1250 property that was removed from your building, you're going to pay recapture on the sale. Now, recapture on 1245 property or personal property is at ordinary rates, and then typically goes down. Capital gains rates are at 20%. So if you have a client that has done some rework of a building that was previously placed into service, and maybe potentially they're going to sell, you want to take a look at whether there might be a disposition or retirement study available to them. It's certainly going to create some deductions in the future in terms of recapture. I have an example of that right here. So again, the previous example being the $5 million, and we ended up with $470,000 of retirements. If they continue to depreciate the $470,000, they'll recapture all of it upon the sale. So let's, for purposes of this example, let's say that $370,000 of that $470 was 39-year property. However, $100,000 of that was 7-year property or personal property. The recapture rate or recapture tax is going to be $127,500, and the math works out there. The $100,000 is multiplied against ordinary income rates. However, if you do a retirement study, the recapture tax on the $470,000 is zero. The capital gains tax is $94,000, and that's creating a permanent tax savings of $33,500 upon the sale. Again, quite significant if potentially you have a client out there that potentially might sell into the future. Removal cost, demolition. So anytime you go into a building and do some work on it, you're going to have removal cost or demo cost to remove the existing assets. So the old rule stated that removal cost for an asset component needed to be capitalized with that new component. However, the new rule is now removal cost of an asset component can be deducted if the taxpayer realizes a gain or a loss on the old component for tax. Again, in an effort to clearly explain, I've got an example. The landlord owns 3 commercial buildings and pays $200,000 for improvements to each one of the 3 commercial spaces in year 1. In year 5, one of the tenants leaves, and the new tenant requires the landlord to gut and renovate the space, costing $340,000. However, when reviewing the AIA or the contractor's detail, it shows $40,000 of the $340,000 was related specifically just to demolition cost to remove the old components. Now, the landlord can expense the $40,000 demolition cost and deduct the remaining portion of the $200,000 that was originally placed into service in year 1. So again, significant opportunity. As a cost-seg professional, many years ago, what we would simply do is just take the $40,000, capitalize it going forward. Now, again, if you're realizing a gain or loss on the old component, you can take that demolition cost and immediately expense it. It might be significant when you've got a contractor that's maybe doing an $8 million renovation on your client's hotel. There's going to be a significant portion of that that is for demolition, creating an immediate deduction in the current year. Of course, you want to go after the dispositions as well. Determining the basis of a removed component. I very often get the response from clients that, hey, John, I'm a tax professional, and it's just simply too difficult for us to understand what was thrown into the garbage. Well, there are many ways that the service has kind of explained that you can use, but if you had a cost segregation study done previously, that should explain what some of those assets cost. Now, you can also use the discount the cost of the replaced component to when it was placed into service using a PPI calculator. And at the bottom of the screen, you will see that KBKG does have a PPI tool that can help in determining some of those costs. So a PPI cannot be used for betterments or adaptations. It's what we're trying to do is understand a like-for-like component. We don't want to compare apples and oranges. It's going to lead us to the wrong answer. So a couple of examples there. Replace an old standard roof with a more expensive solar reflective roof. You can't discount that cost, to understand of the new solar roof to understand, what was the standard roof cost back in the day. It's apples and oranges, and you're in that scenario, very likely going to inflate the allowable disposition. The replacement adaptation, the replacement of an old HVAC system to convert a restaurant or from an office to a restaurant. You can't discount that cost either. Of course, the restaurant HVAC is much more extensive. You've got the kitchen exhaust hoods and makeup air units where you wouldn't have that in an office space. In an office space, it's general human thermal comfort, and it's probably the cost is far less than you would typically see within a restaurant space. Again, take a look at the online research tools if you think that might help you determine those costs. A bit of a caution on the discounting method, and I'll run through an example here, but what we're trying to avoid is grossly overstating a retirement loss deduction if a building was placed into service, let's say within a 10-year period. So in this example, a building was acquired 3 years ago. The owner spent $200,000 to replace aluminum windows in this year. We discounted windows 3 years with a PPI index coming up with a value of $186,000. You took the $200,000, discounting it, and I end up with $186,000. However, this represents the value of brand new windows. So windows had a 3-year life left. So we must apply appropriate condition factor. That's oftentimes not done. So the normal life of a window is 20 years. The appropriate condition factor is 27%, resulting in a much lower value than $186,000. The allowable disposition is $50,000. Again, be careful in trying to discount something without applying an appropriate condition factor. It seems in this slide, in this example, very, very easy to understand, but it's just often overlooked by many people, and of course could potentially put yourself or your client's exposure by grossly overstating the allowable deduction. Again, there's a B&A tax article. If you're in this situation, might add some value. I encourage you to reach out and take a look at that. The plan of rehabilitation is obsolete. So the old rule said that if you did repairs to a building as a larger part of a rehab, you had to capitalize it. Well, the new rule says repair and maintenance costs not incurred by reason of improvement can be expensed. So just because you did it, you did some minor painting on a wall while you were doing an overall renovation of the flooring in the building, doesn't mean that you can't take that minor painting as a current year expense. For example, B spends $500,000 to rewire a building for new lights. Because of the electrical work, I emphasize that, there's $30,000 of cost to cut drywall, patch and paint areas, rewired. All $530,000 needs to be capitalized because cut and patch some of that drywall was by reason of the improvement. So it's to ensure that the rewiring took place appropriately. Example, same, but I flip it on its head. B spends $500,000 to rewire a building and upgrade the electrical system. B spends $30,000 to patch and paint areas of the building completely unrelated to the electrical improvements. Different scenario now. The $30,000 can be expensed. Again, only if it was unrelated to any of the improvements occurring. So I always encourage my clients to get as much detail. Oftentimes, they say, hey, we had $530,000 of improvements that occurred. Great. Based on what my specialty is, I want to see exactly what did they do. What was the scope of work? Please ask the contractor to provide me as many details as possible. I'm asking for that because I'm truly trying to seek out opportunities like this. Can I take a position where potentially $30,000 was a current year expense just because it was lumped in with everything else? The new rules say that I'm not forced to capitalize it. Tax planning opportunities under the new rules. So a taxpayer spends $3 million on renovations in 2010. Of course, KBKG, your preferred cost seg provider, came in and performed a cost seg, leaving $2.5 million left in the 39-year category. KBKG reviewed the construction docs back in 2010, currently in this current year, and it included work for the roof and swapping out some acoustical ceiling tiles, some minor patching and resealing of the asphalt paving, or maybe they just replaced 2 of 20 of the condensing units for the HVAC system. So based on the new rules now, $350,000 should have been a repair deduction, where previously the cost seg capitalized all that. So we can recognize an additional $328,000 on the tax return, of course, by filing a Form 3115. This is accounting method change 184. It's the $350 less, of course, any depreciation already taken, creating permanent tax savings of $17,500 on the sale. So again, you may have already done your due diligence in making sure that your clients have gone through a cost seg during the period of acquisition. However, if that was prior to the final repair regs dropping in 2013, or even prior to the 2011 temporary regs, you want to take a look at, hey, look, because the rules changed, there might be some additional opportunities for my client here. Routine maintenance safe harbor. Expenses if you reasonably expect at the time of placing it in service to perform more than once during its ADS class life. So you can expense it under the routine maintenance safe harbor if you simply reasonably expect to do it more than once. I had an interesting conversation the other day with a gentleman who was creating and manufacturing bushings within the for the automotive manufacturing dealer. And basically, I walked into the place and I said, how often do you expect to do this overhaul, this $500,000 overhaul on this piece of equipment? And he said, well, I expect to do it every 3 years. And I said, well, great. How often, can you show me how often you've done it? He says, well, we haven't done it. I've been here 12 years and we have not done that yet. Well, how can you reasonably expect that you do it every 3 years when you haven't done it in 12? And he pulled out the manual and said, here's the owner's manual, and every piece of equipment at this level certainly comes with suggested maintenance schedules, and it says right here, I should have been doing it every 3 years. Now, in my scenario, I haven't had to do it, and I've elected not to do it, but I certainly can reasonably expect that I should have done it. Maybe some of those manuals are a great way to support why you have taken the position you've taken. Why have you expensed it when potentially you're not doing it on that same schedule? That'll certainly help prove to any auditing service that you have applied the routine maintenance safe harbor rules correctly. An example here, so must reasonably expect to perform more than once during a 10-year period, of course for buildings, when the building system was first placed into service. So the example being, every 5 years the escalator rails need to be replaced. These things take a lot of wear and tear. We reasonably expect to do it every 5 years. Therefore, I'm going to take it as an expense under the routine maintenance safe harbor. Now, it should be noted, and I get the question quite often, it can fail the safe harbor, but still be considered as an expense under the bar test. So, an example here, every 12 years, we replace an HVAC unit. So it fails, of course, the safe harbor, because we didn't do it more than once, or didn't reasonably expect to do it more than once every 10 years. We did it every 12 years. However, it still could be a current year expense by satisfying the bar test. We went through several examples of that. So they replaced one condensing unit of 20. Of course, it's under the thresholds that we understand to expense that in the current year. We just certainly have to make sure that we can support it. Here's an example, refractory brick example. This is a picture of a piece of machinery that's, there was a casting company. They're taking liquid metal, of course pouring castings, and the interior of that furnace is lined with what you see on the right, which is, brick. Well, they have to, this takes wear and tear, and they have to replace that brick quite often. Well, walking through the facility with the facilities manager stated this: yes, we have 3 of these, and we replace the brick during shutdown, 1 a year. So every 3 years, they replace all the brick. Well, that was under the ADS class life for this unit, and they were able to take it under the routine maintenance safe harbor. It was a significant cost too. So again, you shouldn't just look at, oh, $500,000 to replace the brick. Clearly that needed to be capitalized. You have to, of course, understand what the scope of work was, understand how often it's being done, and you might get to a different position. Safe harbor for small taxpayers. You can elect to expense amounts, $10,000 or 2% of adjusted basis of the building. Eligible building, unadjusted basis of $1 million or less. I guess what I want to point out on this is that there may be a planning opportunity under the safe harbor for small taxpayers that you previously haven't thought about. So a cost seg may reduce the real property basis enough to make you eligible for this election. So as an example, before the cost seg, there were 39, it was $1.3 million was all being recovered under 39 years. After the cost segregation, the basis left within the 39-year real property is only $900,000, where the balance, $400,000, is being depreciated under a different asset class, 5 or 15 years. So again, it doesn't come up a ton, but if you're on the bubble there for the unadjusted basis of $1 million or less, you might want to take a look at cost segregation. It might help loop your small taxpayer into this safe harbor. De minimis rule for expensing. So there are 2 different rules: large taxpayers and small taxpayers. So a taxpayer with audited financial statements or applicable financial statements has a safe harbor of $5,000 or up to $5,000 per item or per invoice. Now, I oftentimes get the question, well, which is it? Is it, if the total invoice is $5,000, or can I expense it? And, if it's $6,000, I can't. Well, per item. Understand that if there are multiple items listed on that invoice, very likely you can take this as an expense under the de minimis rules. So, or under the de minimis safe harbor. So, just again, fully know what is listed there within that scope, how many items are listed there. It needs to be called out on the actual invoice itself. Again, you must have a written policy in place stating that your policy is $5,000. It can be less. I oftentimes use the word, we don't want the tail to wag the dog, right? So because you understand that it's anything over $3,000 is going to impact your financial statements, then certainly, $3,000 is appropriate for you. The safe harbor will protect you up to $5,000. I had another client who said, look, our de minimis rule is $10,000. We're a huge taxpayer. Anything less than that doesn't impact our financial statement, and that's fine. So maybe they have special rules set forth with their auditor. They did in this case. The safe harbor will protect them up to $5,000. It's just from $5,000 to $10,000 is what potentially could be an exposure for them. Now, small taxpayers without applicable financial statements is the limits are $500. Now, strike that. That's what they were when the regs dropped in 2013. However, it's now been stated or listed as $2,500 for 2016 and beyond. So, again, it's per item and per invoice at $2,500. Now, in this case, for the small taxpayers, you do not need written expense policies. I know when the tangible property regs came out in 2013, everybody ran around and said, we need to develop a policy. We need to have it signed and stamped, at a certain date, stating what our thresholds are. Well, taxpayers without applicable financial statements don't need to have that. Previously, the communication was that everybody did. So just know that's out there. Of course, if a large taxpayer, you'll know if you're a large taxpayer, they certainly do have to have that written policy in place. There's some anti-abuse rules down there at the bottom. You can't split cost among multiple invoices. Don't go out and buy a $5,000 or a $10,000 truck and say, hey, go ahead and invoice me 6 times. The anti-abuse rules state that that's a big no-no. So you probably know if you're doing it, it certainly needs to be on what the actual item is. The definitions for applicable financial statements, if you have a 10K, you're a large taxpayer, some of this is pretty self-explanatory. But there's some other items listed here that certified audited financial statement accompanied by a report of an independent CPA used for credit purposes. That potentially will allow you to define yourself as a large taxpayer and taking advantage of some higher expensing limits. Again, only if they make sense for your company. I mean, you don't want to start expensing things that certainly don't that are going to impact the financial statements greatly. So just keep that in mind. Materials and supplies. Again, I'm now not just talking about building owners, but let's kind of transition into maybe we have some clients that are in the heavy manufacturing space. Materials and supplies. These are the consumables within the process. It's a pretty significant spend for some of these. This is the fuel, the lubricants, the water that have a useful life of 12 months or less. The unit of property, which is $200 or less. In the temp regs in 2011, that was $100. It was bumped up in the final regs to $200. Again, materials and supplies can be a significant cost when talking about heavy manufacturing clients. Materials and supplies is defined as both incidental and non-incidental. In order to follow the rules, you could file a concurring method change with 184 to comply, which is 186 and 187 for incidental and non-incidental materials and supplies. So in definition, an incidental is where no records of consumptions or physical inventories are kept. These items are deducted when paid. Now, It's a timing issue, right? This is your pens, your pencils, your toilet paper, that kind of stuff. Things that we go to potentially Costco, buy and throw in the closet, we use them as needed. Non-incidental materials and supplies are where records of consumption or physical inventories are kept. So these items need to be deducted when used or consumed. Now, I had an experience with a trucking company, and I was with an auditing agent and the director of tax, and while in the boardroom, they said, are you keeping a record of how many tires you have? Trucking company has a lot of tires. And I said, oh no, we have no idea. There's just a big pile of them in the warehouse. And we walked out to the warehouse and asked the individual standing near what appeared to be an inventory cage with tires in it, how many tires do you have? I'd have to double check, but I think 146. Well, they're certainly keeping track of that. So maybe the director of tax didn't know that, but this is the age of computers, technology. We're almost tracking everything anymore. So just know that you need to really seek out. If you've got an inventory cage, you really need to seek out some additional information on whether or not you are tracking these physical inventories, because there might be a timing issue here. Those need to be deducted when used or consumed, where if you're not keeping track of it, you can deduct those items when paid. Well, waste receptacle opportunity here. You can see the picture on the far right. I've got some beer kegs on the left, and I'll explain that as well. But a taxpayer was unable to use the de minimis safe harbor for waste receptacles since it would cause a material misstatement in GAAP. But they could treat them as materials and supplies and immediately deduct them since there was no book conformity tax requirement. Now, I think it was $185 per toter. And if you can imagine, there was a number of them. This was below the $200 threshold, allowing that company to take a current or an immediate expense. So the same held true for the kegs. There was a pony keg, $135, where the other keg, I think, was $175. They were able to take that as an immediate deduction as well. Again, if you've got clients with these types of assets, you want to make sure that you've appropriately reviewed their materials and supplies policies, and or get them in conformity, and or potentially having a great tax result out of it by allowing them to immediately deduct it where potentially they weren't before. 2015 method changes. We have always been doing change number 7, so this is the depreciation change, such as a cost segregation. This is a change for recovery periods. I was recovering my commercial building over 39 years, and I did a cost seg. It was a look-back study, and now I'm going to have accelerated depreciation 5 and 15 years, change number 7. A couple of other ones I want to note out, that the late partial dispositions opportunity, the 196 change, that opportunity has sunsetted. It was only for 2014. It was basically for, the service came out with new rules, and they wanted to give everybody an opportunity to become compliant. And so they gave everybody an opportunity to take late partial dispositions. That's no longer allowed. They must be timely. Repairs, that's 184. Of course, this is going from a depreciable asset to what could have been a repair, and we're catching up. That adjustment calculation is pretty simple with that. What is the basis minus any depreciation already taken? That's your 481A, or your allowable deduction on the 3115 form. How can KBKG help? So previously I was a cost seg individual. We said, hey clients, if you have a building that's $1 million or more, geez, maybe we could take a look at it for cost seg purposes. Well, now since the rules instead of having clients or CPAs qualify those opportunities, we'd like the opportunity to qualify what we might be able to take advantage of. Just download the fixed asset schedule and we'll do a comprehensive fixed asset review. There may be cost seg opportunities in there. There might be retirement or disposition opportunities. We might be able to move something from, hey, you're currently capitalizing that roof, but it should have been a current year expense, and taking that. So again, a comprehensive fixed asset review certainly helps a taxpayer or the CPA bring a full picture of what's currently going on within their depreciation schedule. Yeah, there might be a cost seg opportunity, but maybe that's not really where a lot of the value is being driven. Maybe it's something we don't even look at. We just go after those items that should have been expensed that are currently on the fixed asset schedule and being depreciated. So again, having a full breadth of knowledge on, hey, these are the opportunities within the depreciation schedule, allowing the experts to vet the opportunities, I think certainly is to your advantage. We also certainly file all the 3115s, or we can help the CPAs do that. We've done quite a number of them over, if you can imagine, over the last several years as people rush to comply with these new rules. So, we've got some pretty good expertise and would certainly be able to perform that 3115 or perform that function and deliver on that 3115, or certainly provide guidance on how to do that. We've developed proprietary software that helps us quickly identify missed repair expenses. So if you can imagine, we ask for the detail and say, hey, give me your full fixed asset download. Well, paralysis by analysis sometimes, thousands and thousands of line items, can be eye-opening. Well, what we have done is developed proprietary software that allows us to review that information quite quickly, determine whether something maybe is a small recovery period change, an expense, maybe perhaps there are some dispositions, turning that into a proposal number, and then take it all the way through implementation. We decide, yes, this is something we want to go forward with. We take that information, the work that has already been done, and then push it through on the implementation phase. So this software certainly has allowed us to turn projects around in a much quicker fashion. I will highlight this software. It's called the Repair Regulator. We use it internally. There are many steps within the process. We from a net present value standpoint, from a time value of money concept standpoint, we'll put a discount rate in there. We'll put potentially what the effective tax rate is, and crunch out the numbers. We'll upload, like I said, the fixed asset ledger. It could be thousands and thousands of line items, and go through. The first item of business is just to sort for keywords. So, roof. There might be an opportunity to deduct that as a current year expense. We look a lot for the rewords: repair, redo, repatch, repaint, repipe. Oftentimes, what that is indicating is that there was something done to an existing asset to replace or to enhance that asset, and we want to make sure that we understand potentially there's an opportunity for a current year expense. I think I have 4 iterations of how to spell asphalt in here, because no one knows how to spell asphalt. So it picks up some of that stuff too. And then of course you've got to massage it. You've got to understand, okay, you've got to have a trained eye looking at it, and that way we'll truly understand what the opportunities are. That is actually what you end up with. What's listed there on your slide from a benefit summary standpoint. What's the first year deduction? ultimately, what people are truly interested in, what's the 481A catch-up and adjustment value? That negative or favorable adjustment is what's going to be taken on the current year tax return. So again, not just using this as a scoping file, but taking it all the way through implementation. Several reports then come out of it, helping you to support the positions that we took in an effort to create that deduction. My contact information here, I oftentimes don't put the real phone number or real email address, but if you contact me, I'll do my best to get back with you. Again, I truly appreciate your time today, sitting down and talking with us about the tangible property regs. If you have any questions into the future, certainly give us a call. Thanks so much.
Thank you for watching. Please look for more programs from the Tax Resolution Institute.